All right, welcome high performance friends and family. This is our January 2018 monthly market update on behalf of my business partner, Thomas Elrod, and I. Just appreciate you tuning in. This will be a monthly gig that we do, and today especially is going to be exciting. If you can see, let's see out there. You're in Charlotte and watching this, you can see that it snowed here, which is like a monumental event. And so I'm going to spend about 30 minutes going through the market. Some of this is national statistics, and then we'll go local at the end. And if you have any questions whatsoever, reach out. You can reach out to me personally, lars@hprea.com, and I'll be more than happy to even give you a free home equity evaluation on your property. Or if you're looking to buy, we can set you up on some of the best deals in the market. And there are really awesome deals in the market, even though we are tight on inventory. So let's get into it here. All right, so actually just I'll repeat myself a little bit. So anyway, welcome. We are live and we're doing a market update on the greater Charlotte area real estate market. And we'll be doing these monthly, which will be super exciting. We are recording. Let me share my screen. I've got some stuff to go through here. And all right, so I promise I'm not going to spend a ton of time going through all this. Really, I want to update everyone. First of all, there was a new tax code, and I want to let you all know what the potential implication was on real estate across the country. And so there was the original tax plan and then what was actually settled on. And I've got to say, huge disclosure here, I'm not a tax person, an accountant, or I'm just not that kind of person. And I still want to let you know three major proposals or proposed changes. First one is changing the requirements for the exclusion of gain on the sale of a principal residence. Second is the reduction on the limit on the mortgage interest reduction, or deduction rather. And number three is the elimination of the state and local tax, which is SALT, which includes property taxes. So let's go through each of these really quickly. One by one. Number one is the exclusion of gain of a principal residence. The original proposal called for you must live in your house 5 out of the last 8 years, and the framework that we were under was 2 out of the last 5 years in order to avoid being taxed on the gain. And here there was no change. So the proposal did not go through, and the impact on the market is none. So we're staying at 2 of 5 years. The second is the mortgage interest deduction. So the original proposal was to reduce the limit on the mortgage interest deduction from $1 million to $500,000. And the new tax code reduces limit on deductible mortgage debt to $750 on new loans taken out after 12/14/17. And any loans up to $1 million are grandfathered in. So impact on the market, I'm going to slow down here a little bit. Assuming a 20% down payment, this reduction in the mortgage interest deduction will only impact buyers that are purchasing a home between the prices of $938,000 and $1.25 million. And there's a little bit of a disagreement in terms of what the implication might be, where Bill McBride of Calculated Risk says, I think the impact of reducing the mortgage interest deduction from $1 million to $750,000 will have very little impact on the housing market. And then Capital Economics states, the impact on expensive homes could be detrimental with a limit on the mortgage interest deduction, raising taxes for those that itemize. So a little mixed opinion there. Then state and local taxes, including property tax. The original proposal was for the elimination of state and local tax deduction. And the new tax code allows an itemized deduction of up to $10,000 for the total of state and local property taxes. So that really same sort of implication here, just on higher end properties where your property taxes are in excess of $10,000. I'm going to skip this here a little bit too much, and I'll make these slides available in case anybody has any questions. You guys can go through it. All right, so let's do a big market overview for 2017. How did we finish overall as a country with respect to real estate? So first off, new home sales are at the highest level in a decade, which is awesome if you're thinking of selling, and I'll tell you why that's even great if you're thinking of buying. Number two, sales of previously owned homes, so we call those resales, are at the highest level in more than a decade. And then new build starts of single family homes are strongest in the decade. And advanced beyond August 2007, which was the last strong point, over 10 years ago in new build starts. So new home sales, resales, and new build starts are all up, highest levels ever. Real quick, mortgage rates. So projecting an increase in mortgage rates from around 4% right now, and you can see there's basically Freddie Mac, Fannie Mae, the Mortgage Bankers Association, and National Association of Realtors, all are predicting an increase in interest rates. If you look from up above here to down below, from about 4.0% the start of this year to 4.5%. So we will see a rising of interest rates, at least projected, this year. Total home sales will be up. I know this doesn't look like dramatic. This is nationwide, from about 6.2 million to 6.3 to 6.5 million. So about an 8% increase in the amount of homes selling after a year of really tight inventory. This is good news as well. Buyer traffic, you can see, is up dramatically, even from the peak spring months. So March, April, May historically are the highest months of buyer foot traffic, and you can see that even in slower months, October is typically not a high month; is very high compared to the spring market. Bloomberg Business says America's housing market, let me move my thing out of the way, is gearing up for a robust year ahead, meaning 2018. Builders are more optimistic. Demand is strong, and lean inventory is keeping prices elevated. What's more, the tax legislation signed by Trump may not pose as big a risk to demand from home buyers as earlier versions did. So bottom line, the tax code changes didn't go through the way they originally thought they were going to go through, and they're likely not going to have as big an impact. So what are all of you saying about the tax code changes? So ask the question, how will the tax bill likely influence your home sale this year? 57% said no impact, 13.9%. And if you combine those, about 71% said either no impact or you'll sell faster. Only 10% said you'll sell slower, and then 7.6% said you will postpone your sale. So not a big shift there. In terms of buyers, 29.2% said they would buy faster, 22.9% said no impact. Some said less expensive, postpone plans or a different location, and 18.5% said buy slower. So just like in any market, there's emotion baked into these things. Overall, buying a home is still a huge part of the American dream. Some say, 18% say it's the most important, part of the American dream, quote unquote, is owning a home. 53% say very important, and 22% say somewhat important. So homeownership is still a big deal, and it's a key part of the American dream. And then just overall, in reaction to these changes, you could see buyer traffic has increased. And year over year, in October, you could see a substantial increase. November, the same. We expect December and January to be very, very similar. Our real estate team is coming out this year very hot in terms of listing homes, so a pent-up demand of folks getting ready to sell their homes, and then really seeing some really good traffic here in the local Charlotte area. Dr. Frank Nothoff says single-family residential sales and prices continue to heat up. On a year-over-year basis, home prices grew in excess of 6%, and that's true nationally as well as locally here, for 4 consecutive months, the longest such streak since June 2014. This escalation in home prices reflects both the acute lack of supply and the strengthening economy. So a couple things working there. Lawrence Yun, he is the National Association of Realtors chief economist, says the healthy labor market and higher wage gains are expected to further strengthen buyer demand from young adults next year. Their prospects for becoming homeowners will only improve if more lower price and smaller size homes come onto the market. And you'll see here when I go through some of our local market stats that we have a very tight market, and anything under 300,000 going very quickly. And so there's a shortage of that type of inventory in our market. You'll see this same thing locally here in Charlotte, that our inventory is around 2 to 3 months of inventory. A healthy market, a balanced buyer-seller market, is around 5 to 6 months of inventory. So depending on where you're moving, if you're trading up, there's always differences in area of the city, and also in price points. If you're selling a 300 to move into a 600, those are two different markets and they'll have different dynamics. And so some of these things we need to make sure we really slow down and look at your specific situation. And so if you have any questions, again, email me directly, lars@hprea.com, or you can go on our website, highperformancerealestate.com, and you can request a free home equity evaluation right from the site. Inventory levels, we talked about, they are creeping up, heading into 2017. So that's just an old slide. I'm just going to delete that one. New homes sold. So this is just new home inventory from the builders. You could see it's not quite back to the levels that we saw in 2006 and 7, but they're raising up considerably. And even in the local Charlotte market, that's one of the things that builders have been a little slow to respond to our inventory levels. Here's a national snapshot of price changes year over year by state. You can see North and South Carolina at 5.3% and 4.9%. The darker areas in the country, see Washington at 12.5%, Nevada 10.1%, and then you can see poor West Virginia at 0.4% increase. So healthy gains in terms of appreciation. And I'll go through projected appreciation rates as well here, and really help dispel any thought of a bubble or anything like that. The economic drivers in this market are considerably different than they were 10, 12 years ago. And so I'll go through some of that as well. And these are the forecasted growth rates. You can see for the next year, North Carolina is at 4%, South Carolina is at 3.8%. So there's still upside in our market. House price appreciation. This is annual percentage change year over year. So you can see the increase in the boom years, right? The boom years are typically anywhere from 2000, 2002 to 2005. That was the irrational sort of bubble craziness that was going on in a lot of markets. We were tempered a little bit here locally in Charlotte. And you can see all of that appreciation from those boom years was taken away in the 2007 through 2011. And now we've had, some healthy gains, and now we're settling in at really sort of good but not irrational appreciation in our market. And you can see just a comparison, 2002 to 2005 versus 2014 to 2017. We're not in that, double-digit, high single-digit, double-digit growth like we were back in the crazy days. And if you look at it average, it was close to 11% increase in the 4-year period leading up to the bust. And it's only in the last 4 years, it's just about 6%. So a full 5% less. If you're thinking that a bust or a bubble is upon us, it's not projected to be. So again, I do not have a crystal ball. And this is just what the data tells us and the experts are saying. So Bill McBride, and you'll hear of him a lot, in April 2005, this is what he said, and he predicted what happened back then. A bubble requires both overvaluation based on fundamentals and speculation. It is natural to focus on an asset's fundamental value, but the real key for detecting a bubble is speculation. Speculation tends to chase appreciating assets, and then speculation begets more speculation until finally, for some reason, that will become obvious to all in hindsight, the bubble burst. So 2005, in terms of percentage of investor purchased homes, it was 23%. And in 2017, it's a full 10% less, which is a healthy level of investor purchases, is about 8 to 10%. So we're not getting into that crazy range where folks are buying homes for the mere fact that they think they're going to increase. So Bill McBride in 2017 said this: in 2005, people were just buying homes and letting them sit vacant and then selling them without significant improvements. Classic speculation. And even more dangerous during the bubble was the excessive use of leverage, all those poor quality loans. Currently, lending standards are decent and loan quality is excellent. So prices may be a little overvalued, but there is little speculation, and I wouldn't call house prices a bubble. And I don't expect house prices to decline nationally like during the bust. Frank Martell of CoreLogic says the acceleration in home prices is good news for both homeowners and the economy because it leads to higher home equity balances that support consumer spending and is a cushion against mortgage risk. And so as you get more equity in your home, you're less likely to, you're more guarded against that equity, and folks are more likely to make their payments versus if the market tanks and your equity goes away, you don't have a stake in your home. The bank owns the whole home because there's no equity in it. So you're less unfortunately, you have a less of a feeling that you need to pay that mortgage. Which is what happened back in the crazy days. People just stopped paying their mortgage because the market took away their equity. Dr. Frank Nothoff again says homeowner equity increased by almost $871 billion over the last 12 months, the largest increase in more than 3 years. This increase is primarily a reflection of rising home prices, which drives up home values, leading to an increase in home equity positions and supporting consumer spending. So equity share, you can see by state, there are very little, if we looked at this, 6 or 7, 8 years ago, most of the country would be in a different position entirely. So in North and South Carolina, 96.3% of homes are in an equity position where they're not underwater. Again, probably most of the country was, in the orange danger zone in terms of, homes that actually had equity in them. And then South Carolina is 95.9. So just roughly about 3.5–4% of homes in North and South Carolina don't have equity, which is good news if you're looking to make a potential move. And significant equity greater than 20%, we're at about 82% in North and South Carolina. Of homes have greater than 20% equity. And that's really when folks begin to feel comfortable making a move, making a trade, moving to a different area of town. We recently moved because the commute was killing us to the school that our kids go to. And then average equity gained year over year. So if you were a homeowner, you made $9,000 last year in North and South Carolina. Pretty cool. And so if you don't own a home, you've got to reach out to us. We can change that and help you with that. Tenure in home, because of the decrease in values back in 2008 through 2007, 8 to 2011, 12, in that time period, increased substantially because folks couldn't move. They had no equity to make a move, and they didn't want to do anything, put themselves in a distressed sale situation, a short sale, or just walk away from the home, which unfortunately, again, a lot of folks did back in those tough years. So average tenure in home, so there's a built-up demand of folks that would likely make a move. And so what we're seeing now is that you have the equity to make a move, and you might just not realize it. So these numbers will come down closer to the historical average, about 6 to 7 years average tenure in homes before folks make a move. So again, reach out to us or go to highperformancerealestate.com for a free home equity evaluation if you're thinking of making a move and you want to see what your equity position is in. So every month we'll do a home price expectation survey. And this is really, again, it's the future, so no one can predict the future. And what they're telling us is that anywhere from 3 to 4% increase year over year for appreciation of homes. And if you compare the bulls versus the bears, the bulls think over, by 2022, so looking back here, that's 1, 2, 3, 4, in the next 5 years, the bulls think that there will be a 34% increase in home values. So if you have a $100,000 home, that home could be worth $134,000. The bears still are predicting a 12.4% increase over that 5-year period. So a $100,000 home would be worth $112,000 $400. And the average is telling us that a $100,000 home will be worth $123,000, $123,400. So all projections, the bulls and the bears, over the next 5 years are predicting a 23.4% increase in home values across the country, which is pretty awesome. And most of us, don't have, we don't own our homes 100%. And so really on the equity portion, if you have, let's say you own a $100,000 home and you have 20,000 of equity and your home goes up to 123,000 over 5 years, your $20,000 of equity turns into $43,000 of equity. So your equity position in the home actually doubles. And I don't know anywhere where you can get a 2 times increase over 5 years in terms of an investment. So real estate still looks to be an awesome investment. So if you take a $250,000 home and you apply that 23.4% average growth, you're looking at almost a $45,000 gain in family wealth if you invest in real estate. Rents, don't even need to put exact numbers on here. It's basically a 45-degree increase, and rents in our market continue to go through the roof. Historically, Charlotte has been in we haven't had enough rental properties. And so as rental units become available, the rent rates are insane. So after about a 2-year slowdown, rent growth is starting to pick back up across the nation. Looking into 2018, rent is expected to continue gaining. More widespread rent growth could mean home buying demand stay high as renters who can afford it move away from the unpredictability, because you have no control of what your landlord does, of rising rents toward the relative stability of a monthly mortgage payment instead. All right, let's do some updates. I'm going to go through these fast and furious because I want to save a little bit of time. We've got about 10 minutes remaining here, and I want to save a little bit of time for just some local market stats. So one thing we need to talk about is distressed inventory. So this is short sales and bank-owned homes. From a peak of about 35%, only 4% of our inventory currently is distressed sales. So in any market, you're going to have folks that have come across bad times or are in a difficult situation, a short sale situation, which is basically going to the bank and just letting them know you need to sell the home and you don't have equity, and they'll negotiate with you, or straight up bank-owned property where someone stops paying the mortgage and they turn the property back over to the bank. So we're about 4%, which is healthy. Home prices in terms of year over year on existing homes, you could see in the South we're at 4.8%, which we talked about earlier. The West and Midwest are ahead of us, and the Northeast, for just different reasons. A lot of people are moving away from the Northeast to the South, which is cool. To be in a better climate. That's if anyone from the North, I used to live in New Jersey. If you're watching this, reach out to us. It is a much easier life down here in the Carolinas. I promise you that. So a 20-city composite called Case-Shiller looks at year-over-year price changes along these 20 cities. And you can see, this goes back monthly through January 2014. You can see as the market was recovering from the 4 or 5 year lull, we've sort of steadied out at about a 6% increase of 20 of the largest cities. And then if you look at sort of a normal rate of appreciation, we're at about a normal rate of appreciation currently. Forecasted growth, we covered this, about 4%. Let's go through some housing inventory. So seller traffic. So demand for listings, especially in Greater Charlotte, right? I have a selfish interest in you potentially looking at selling your home, and we'd love to interview for the job of representing you, marketing your home, getting you top dollar in the least amount of time and most amount of money, least amount of hassles. And that's my little commercial there. We need inventory. We are desperate for inventory. North Carolina, we had about 2 months of inventory in Greater Charlotte. And it's not good. And so if you've considered making a move and you think you didn't have the equity, again, the situation may be way different than you think. Buyer traffic is strong. So there are lots of buyers out there looking for homes, and there's just not enough inventory. So again, if you're a buyer, the 5-year projections of increase in value, 23.4%. It's a good reason to buy a home. Right on that $250,000 home, there's a potential $45,000 increase in home equity and wealth to your family. And if you're a seller, there's low inventory, so homes are going quickly and they're going for top dollar. So the buyer gets to buy the home, they have the upside of the appreciation, and then as a seller, the way things look now, it's an awesome time to look at it. So foot traffic over the last few years, you can see in October, that was the most buyer traffic we've had come through in a long, long time. You could see 2016 over 2017. Most of the darker bars here are bigger than the month from the year before. So especially in October, you could see it's almost double, which is crazy. Interest rates, we talked about this. They're forecasted to increase about 0.5 point this year, and 0.5 point, 4.5%, relatively speaking. I'm not going to say, back when I was young, I walked to school uphill both ways in the snow. I did purchase my first investment property. It probably was about 2000. And I remember the rate was in the 8.5% range. So that wasn't like the 18% range, like some folks can tell the stories about. But I remember that was sort of the start of the decline. I refinanced that home in less than a year for, I think it was like 7% or something crazy. And then, they settled in at about 6% for a whole bunch of years. And then they went to 5 and like, man, 5 is low. And now everyone forgets, that 6% is a crazy low rate. And now, folks get a little cranky when rates go up to 4.25% or 4.5%. Either way, it impacts buyers' buying ability. Mortgage credit availability, so remains high. This is the last 4 years, basically an indicator of the ability to borrow money for a home. Average days to close a home, it got real high in there when everyone was sort of freaking out about all the bad stuff that happened. And so you can see there, average credit scores are sometimes lower than you think they are. You can see here the average FICO score of home purchasers. There are a good chunk of the market is below 750 average FICO score, 53%. So you can still get a good deal on a property. All right, so let me see if I can switch over to, I want to give you guys a market update here. And I just want to show you what we could do locally. New share. All right, so really anywhere you live, any area. So this is just our local MLS. And so this is looking back 10 years. I can even go max here. So I can look back to the beginning of 2004. It's not the way we value homes. It's price per square foot though. And it's for the entire MLS and all the price ranges. So you can see in our market, one of the best things we have going for us is that homes are affordable. Even though we're at, higher than we were back in 2008 when the market declined, this is still $100 a foot, $114 a foot. If you look at, different price points, you could see if you're 500 to $1 million, you could see the price, the dollar per square foot is a lot higher. So it was about $180 a foot, and we're at 177. So we're not where we were. And relative to other parts of the country, this is still a very low number, which is interesting. So we could just pull single family homes. And so there's a lot of good stuff that we can do here. One thing I want to show you is days on market, and go back to the max. So this is 2007, single family home days on market. We're sitting at 18 days on market when things got really bad. Overall, we had an average of about 92 days on market. So we need inventory. Homes are going quickly. Again, what we do a little differently than most traditional agents, traditional methods, is that we put a really high-powered marketing effort behind getting our listings sold, about $35,000, $40,000 a month. We have 2 full-time marketing folks, a virtual assistant, and what we do is we get about almost 3% higher than the market average in terms of listings sold. And our listings are selling about 40% quicker, and we're getting more money. And the process that we use is, we call it our high performance experience. If you've ever been to a Ritz-Carlton versus a Courtyard Marriott, you'd know what the difference is. So again, so these are some of the things. We can go neighborhood specific on this. Let me say one more thing here. So closed, so month supply. Let me show you month supply. So back in the boom days, we're about 4.7 months supply, and we're at about 3.5 months supply right now. And you could see if I click on 250 or less, I suspect it's going to be a whole lot less. So we're at 2.1. So there's a lot less inventory at the lower price points. If I click 500 to a million, we are at 8 months supply. So if you're trading up, the market in 500 to a million is a whole lot different than the market even, so you can see this is an indicator of demand. 8 months supply, 500 to a million, and 250 to 500, there is 3.8 months of supply. So the market is moving twice as fast at the lower price point. So if you're trading up out of the 250 to 500 and you're trading into that 500 to a million, there's an opportunity to take advantage of a more sluggish market when you're selling in a hot market. Same goes for 250 or less, trading into 250 to 500. So the bottom line is, and let me stop this share here. The bottom line is that if you have any questions whatsoever about your real estate situation, if you're looking to buy a home, if you're looking to sell a home, if you're looking to invest in real estate, or you're looking even for a fast-paced career in real estate, please reach out to me personally, lars@hprea.com. And if you know anyone looking to buy, sell, invest, or for a career in real estate, reach out to me as well. Or you can visit us on the web at highperformancerealestate.com. Much love to all of you, and hopefully you're enjoying this awesome day off from school. Our kids are off today. They've been out, what time is it now? About 11 o'clock. They've been out since 7 a.m. My son woke me up and we went out sledding, which was awesome. So hopefully you're having the same sort of day, just a day around the house to enjoy your family. Stay safe, stay off the roads until they dry up, and we'll talk to you next month with another installment of our monthly market update. We'll talk to you soon. Bye-bye.